Humans are hardwired to look for patterns, especially in systems as complex as the stock market. But the market is not a casino. At its core, it operates as a massive information processing contest. Before analyzing the numbers, we have to understand the tangible reality behind them. A stock is simply a residual claim on a corporation's assets and profits. A corporation holds a collection of assets and cash. To distribute those resources, there has to be a sharing rule. If the company owes money, bondholders and creditors get paid first out of that bag. The stockholders get whatever is left over. Because stockholders are last in line, they take the ultimate financial risk if the company loses money and the bag shrinks. In exchange for absorbing that risk, ownership grants them control over how the company operates. Buying a share means tying your capital to the physical, everyday operations and the long-term risk of a real-world business. Financial economists evaluate this system through the efficient market hypothesis. The theory states that all known available information about a company is instantly baked into a stock's current price. If the price accurately reflects all available data, the market is offering a fair deal. Consequently, stock returns appear nearly random, moving up or down unpredictably as new information arrives. The historical record supports this idea. Year after year, the vast majority of professional money managers fail to match or beat the broader market average. Yet look at any historical trading floor. Active traders dedicate their lives to outsmarting the system, constantly hunting for an edge. Curious, if mathematical models suggest stock prices follow an efficient, random walk, how do active traders systematically attempt to beat it? The answer starts with understanding where the trading happens. Almost all daily volume takes place in the secondary market, where money simply moves from one investor's pocket to another, not to the issuing company itself. To navigate this fast-paced exchange, active traders use a different toolset entirely: technical analysis. While a fundamental investor evaluates the long-term health and physical assets of the underlying business, a technical analyst focuses purely on charts, trends, and historical market movements. They operate on the belief that human behavior creates recurring mathematical patterns that can be recognized and exploited. Technical analysis attempts to take the abstract, chaotic market of buyers and sellers and transform it into a quantifiable, objective landscape. Traders apply complex mathematical calculations directly to price charts to filter out the noise and locate actionable signals. This image shows charts packed with technical indicators. Primary metrics include momentum, measuring the rate a price changes. Traders also calculate relative strength index to identify overvalued assets and utilize Bollinger Bands, where hitting an edge creates a strict trading rule. Traders also use derivatives, such as options and arbitrage strategies, allowing them to hedge their positions and profit even when the broader market is bearish. Active traders do not rely on gut feelings. They build mathematical scaffolding to systematically identify and exploit short-term inefficiencies. Whether holding a stock for decades based on corporate growth or trading it in minutes based on rapid price action, investors are participating in the exact same ecosystem. Both philosophies are entirely governed by a single constraint: the management of risk. This chart shows the historical range of annualized portfolio returns over different holding periods. Over a single year, returns wildly fluctuate between massive gains and steep losses. As the period stretches to 50 or 75 years, that rate converges toward a predictable average. But this chart shows what happens to the actual dollar values over those same periods. While the percentage rates narrow, the potential range of final portfolio outcomes in pure dollars expands significantly the longer an investor stays in the market. Because the final outcome is inherently uncertain, stocks must offer higher baseline returns than safe assets to convince people to buy them. Economists call this the equity risk premium. There is no free lunch. Whether you invest passively or actively hunt technical signals, success depends entirely on accepting and managing the absolute trade